Apple stock is experiencing a big old I flop on Wall Street on Thursday. Shares plunging after the company's earnings did not meet the extremely high expectations of Wall Street. Actually, let me backtrack for a second. Yes, Apple's earnings actually did surpass estimates, but sales were a little bit light, and the company's guidance doesn't look all that great either, sort of. See, here's the thing you have to realize when investing. Apple is not doing poorly. Despite all the negative headlines you're going to see today about what Apple needs to do to get back on track or fix itself or save itself, this is a company that has more than $137 billion in cash, had one of the best quarters in history when you look at what their actual profits were. Revenue growth is still very strong, even though it's below estimates. The problem with Apple is just that even after the huge drop in the stock price following the release of the iPhone 5 in September, expectations are still pretty high because it's Apple. This is all about expectations and relative performance, not absolute performance. Just look at two other tech stocks moving on Thursday. Nokia getting killed, and rightfully so. Its sales plunging, it's cutting its dividend. Then look at Netflix. Netflix is up about 40% in early trading, but Netflix still has all the same challenges today that it had before earnings. It still has a lot of competition. You know, streaming video is a very competitive business, but Netflix beat expectations and the guidance is higher than forecast. That's why its stock is up and Apple stock is down. It's not because Apple is an inferior company to Netflix. That's just silly.